A significant downturn marked Asian share markets at the beginning of the week. This movement was broadly linked to anticipation surrounding the expected announcement of extensive U.S. tariffs. Key indicators reflected this dynamic. MSCI's broadest index of Asia-Pacific shares, excluding Japan, experienced a decline approaching 2%. Simultaneously, a gauge measuring Asian emerging market equities recorded a 2% drop, reaching its weakest position since early March. Financial analysts observed that such tariffs, if implemented as anticipated, could present substantial operational difficulties for economies heavily reliant on export activity, a characteristic feature of many emerging Asian nations, several holding significant trade surpluses with the United States. This reaction was not confined to a single index. Downward pressure was evident across numerous national equity markets as the trading quarter drew to a close. The extent and nature of this impact, however, varied considerably across the region, reflecting differing economic structures and specific trade exposures. Illustrating this varied impact, South Korea's KOSBI experienced a 3% decline, reaching an 8-week low. This market reaction aligns directly with assessments identifying the East Asian nation as particularly exposed within the region should the anticipated U.S. measures target the automotive sector specifically. A similarly pronounced reaction was observed in Taiwan. Its benchmark index registered a 4% plunge, while the Taiwan dollar weakened, hovering near a 9-year low against its U.S. counterpart. Taiwan's position as a major exporter of high-technology products, notably semiconductors, and its inclusion among economies maintaining substantial trade surpluses with the United States, underpin this heightened market sensitivity to trade policy shifts. Further south in Thailand, the benchmark stock index touched levels not seen in almost 5 years. A notable contributor to this downward movement involved Delta Electronics Thailand, whose shares decreased markedly on the day. This specific corporate pressure occurred within a context where the electronics component manufacturer's valuation had already faced scrutiny since peaking late the previous year, indicating that the broader tariff concerns likely amplified pre-existing market anxieties regarding core earnings and valuations. These specific national instances reflect the operational reality articulated by analysts. That the prospect of new tariffs introduces significant friction for economic models heavily geared towards exports, a foundation upon which much of Asia's recent economic expansion was built. Extending the view beyond the single day's trading reveals a pattern of sustained pressure over the preceding months. Looking at the quarter ending in March, several Southeast Asian equity markets registered substantial declines. Stocks in Indonesia and Malaysia, for example, decreased by approximately 8% over the 3-month period. Thailand's market experienced an even more pronounced drop, falling over 17% during the same timeframe. This downturn corresponded with significant capital movement. Data indicates that foreign entities withdrew more than $4 billion from Southeast Asian stocks during the March quarter. This represents the most substantial combined outflow observed since 2020, signifying a concrete shift in international investor positioning relative to the region amidst the evolving trade environment. Yet this regional trend was not entirely uniform. Singapore presented a notable counterexample. Its Straits Times Index actually recorded a gain exceeding 5% for the quarter. This positive performance, largely attributed to the strength of its banking sector, occurred despite acknowledged vulnerabilities related to potential U.S. tariffs targeting pharmaceuticals, suggesting that specific domestic factors or sector strengths can, in certain circumstances, offset broader regional pressures. Further complexity arises when examining currency markets on that particular Monday. Contrary to the equity sell-off, most Southeast Asian currencies posted slight gains against the U.S. dollar. The Thai baht, the Philippine peso, and the Singapore dollar all edged marginally higher. This dynamic was linked to concurrent movements in global bond markets, specifically a flight towards the perceived safety of U.S. Treasury bonds, which temporarily exerted downward pressure on the dollar itself. Indeed, these three currencies were positioned to conclude the March quarter, showing strength relative to the greenback. However, this apparent resilience in the currency sphere during the period of heightened tariff discussion is viewed by some analysts as potentially temporary. Projections for the upcoming second quarter anticipate a reversal, with an overall depreciation expected for Asian currencies against the dollar. The rationale rests on the expectation that underlying factors, including the impact of tariffs and differing national economic trajectories, will exert greater influence over the medium term, leading to varied degrees of weakening across the region depending on specific exposures and domestic conditions. Analyzing these distinct market behaviors reveals a complex interplay of factors. The sharp declines in equity markets across export-heavy economies like South Korea and Taiwan stand in contrast, at least momentarily, to the relative stability or slight strengthening observed in some regional currencies against the U.S. dollar on that specific day. This divergence underscores that market sentiment driven by trade fears can decouple from short-term currency mechanics influenced by broader global capital shifts, such as safe haven flows into U.S. debt instruments. Crucially, these market adjustments occurred largely in anticipation of formal tariff announcements. This highlights the operational reality that the mere signaling of intent regarding significant trade policy changes can trigger immediate, tangible consequences in financial markets. Investor decisions and capital allocations are adjusted based on the perceived trajectory of policy, demonstrating the preemptive impact of expected economic friction. The recorded $4 billion net outflow of foreign capital from Southeast Asian equities over the quarter provides concrete evidence of this anticipatory risk assessment. This movement represents a significant reallocation of international investment, the largest such quarterly withdrawal since 2020, directly coinciding with the period of heightened uncertainty surrounding U.S. trade actions and their potential effect on regional growth and corporate profitability. Furthermore, the varied performance across nations and sectors reinforces the targeted nature of these economic pressures. While broad tariff announcements create widespread concern, the specific vulnerabilities, automotive components in South Korea, semiconductors in Taiwan, pharmaceuticals in Singapore, dictate the severity and focus of market reactions. Conversely, specific sector strength, like Singapore's banking industry, can provide a degree of insulation. This differentiated impact reveals how national economic structures and dependencies shape the reception and consequences of international trade policy initiatives. Taken together, these events underscore the profound degree of economic interdependence linking Asian export economies to U.S. trade policy. The market sensitivity observed functions as a clear indicator of how shifts, or even anticipated shifts, in U.S. tariff structures can directly influence perceptions of economic stability and investment security within the region. Announced trade measures act as an effective lever with demonstrable market consequences. The substantial capital outflows recorded during the quarter provide empirical validation of this linkage. The mobility of international capital, evidenced by the rapid $4 billion withdrawal from Southeast Asian stocks, demonstrates how perceived risks associated with trade policy translate into tangible financial reallocations, impacting national investment climates and potentially balance sheets. Furthermore, the specific pressure points identified, automotives, high-technology components, pharmaceuticals, reveal underlying structural vulnerabilities within certain national economies. The concentration of exposure in these key export sectors highlights potential choke points that could influence future national economic planning or prompt considerations regarding industrial diversification strategies. Ultimately, the sequence of market reactions preceding the formal tariff announcements serves as a case study in the power of policy signaling. It confirms that the communication of intent regarding significant economic measures can generate immediate operational effects, altering investor behavior and market valuations well before policies are fully enacted, thereby shaping the strategic environment in advance. The entire dynamic illustrates a complex reality where trade policy concerns intersect with global capital flows and specific national economic profiles, producing outcomes that require careful, dispassionate assessment based on observable facts. What unfolds in these Asian financial centers, then, is the operational consequence of perceived shifts in the global trade architecture. The observed market adjustments and capital movements are concrete manifestations of risk calculus applied to highly interconnected, export-driven economies. Anticipation of policy functions as policy itself in driving immediate financial outcomes, revealing both the deep sensitivities and the varied structural exposures across the region. The temporary divergence between equity sell-offs and specific currency movements highlights the complex mechanics at play, yet does not negate the underlying economic pressures widely anticipated by market participants. This entire episode fundamentally demonstrates the direct, observable linkage between strategic trade signaling and tangible economic effects within interdependent systems. Thanks so much for watching. If you enjoyed this analysis, and be sure to give it a thumbs up and hit that subscribe button for more geopolitical insights like this. I love hearing your thoughts, so drop a comment below and let's keep the conversation going. Share this video with anyone interested in deeper perspectives on current events. Until next time, stay informed and think critically. Thank you.